A very good afternoon to all of you, Financial Management 2A students all around the country, all campuses of Varsity College. The voice that you're hearing belongs to me. Name is Cheryl Morford. I'm the module leader for FINM 6221. So throughout the semester, I'm going to be doing some master classes for you to prepare you for your first test, which you guys are writing next week, and then for test 2, and then finally for the exam, which will be at the end of the semester. So today we're going to be talking test 1, which I hope you guys know by now is covering Learning Unit 1 as well as Learning Unit 2. One small change in terms of the mark allocation. All tests will now only be out of 50 marks, not 60. I thought you guys just needed to know that. So what I want to do, 3 separate recordings, one of them on the theory in Learning Unit 1. Then the others are going to be ratio calculations. I'm going to do a question for you on investment ratios. And I'm also going to do another question involving all of the other ratios. So just give me a short while, please, to set up and share my screen. I'm not disappearing. I'm just getting myself ready. So here we go. We should be sharing screen. And this is the document that I want. Right, you must definitely expect questions coming from Learning Unit 1 in the test. I would say anything between about 15 or 20 of the marks coming from Learning Unit 1. It is as important as Learning Unit 2. The exam will probably have less from Learning Unit 1. That's why you need to make sure that you do study it thoroughly to maximize your mark for test 1. I know some people who are more numerically minded do not like the theory, and they think they can just get by without paying any attention to the theory. I'm discouraging that entirely, especially for test 1. Otherwise, you're going to put yourself at risk by not being able to answer the theory questions. Right, so let me just take you through some of the main parts of Learning Unit 1. So the learning unit begins with objectives of a business, and there are 2, which are well explained in the book. I just need to make sure that everybody does indeed know the difference between them. So one of them is maximizing profit, and the other one is maximizing the wealth of the shareholder. So you need to be able to explain the meaning of both of them. And you need to be able to say how each is measured, and in particular, which one of the 2 objectives is followed in accounting and which one we will be following in financial management. So one of the objectives is far superior to the other because one of them leaves out too many things. So there are many limitations or drawbacks associated with the maximization of profit. So just as I said, make sure you can explain them, point out how they're different. Profit maximization is measured using a ratio called earnings per share. It exclusively concentrates only on profit. Shareholder wealth maximization is measured using the current share price and includes all variables that may affect the market's perception of the value of a share. Right. Then the next section that comes up are the roles of the financial manager. So there is a general, broad description of what financial management entails, but I want to take you through the actual responsibilities that are carried out on a day-to-day basis. So we can distinguish between primary responsibilities and secondary or other. Starting with the primary, there are how many? three. You need to be clear what those are. So, financial planning and analysis, investment decisions, financing decisions. Each of them has a few subcategories. So, financial planning and analysis essentially involves two things: the preparation of financial forecasts and budgets. You also need to briefly be able to explain financial coordination and control. Know the difference between a forecast and a budget. So it really depends on the time period for which these financial forecasts and budgets are prepared. Also, make sure that you know how the forecasts and the budgets can assist the financial manager in making decisions and in planning and making sure that the business is operating in such a way that it maximizes the wealth of the shareholders. Yeah. Next up, we have investment decisions. And we can here distinguish between investing in short-term or medium to long-term investments. So ST over here is short-term. This next M/LT, medium to long-term investment decisions. So when it comes to the short-term investment decisions, this could be, for example, investing in inventory, making sure that working capital is managed efficiently so that funds are available in the short term to be spent on whatever is needed. Okay. The medium to long-term investment decisions relate to investment in non-current assets. And there are 5 of those that are identified in the textbook under the heading 5 key investment decisions. So please make sure that you are familiar with those. Then comes financing decisions. So how is a business going to obtain the funds to finance the business? So there are 2 ways. I will just type them up here quickly for you. Either, I'm just going to make it a bit bigger, sorry, it's a bit small. You can borrow from financial institutions, in which case you have debt, or otherwise you can issue shares, in which case you are going to have equity. Let me just move that so it fits on the screen. Okay. So what the financial manager has to do here is determine the split between the debt versus the equity. And obviously, they will be guided by a target debt equity ratio. And that ratio we will have a look at in the next recording. Then, if we get on to the secondary or the other responsibilities, I will name them for you. There's 4. Okay. Cash management, very straightforward. Relationship management, as well as risk management and dividend decisions. So out of all of those, I would say that relationship management is the most important because there's the most basically happening in there. So it means that we need to establish and maintain positive relationships with anybody who is affected by the business. And these people are what we call stakeholders. That is a very important term. Not to confuse with shareholders. So you must be able to name about 5 stakeholders. For example, we have shareholders who are the investors. We have suppliers. We've got customers. We have got creditors. We've got employees. We've got the government. We've got the community. So you must be able to name them, state what their objectives are. That's another important thing. And lastly, how they would be affected by the financial decisions and why they are interested in financial statements. Okay. So there are some nice questions in the textbook that you can use to make sure that you understand this and are ready to answer questions on these. Okay. Then coming to dividend decisions and risk management. Okay. In terms of dividend decisions, this basically relates to the profit of the business. So what can we do with the profit? Two things. We can either, it's not going to let me draw here, which is a bit of a nuisance, over there or over here. So we don't have the same annotation tools that we used to have in Blackboard. So it is a little bit tedious. So with the profit, we can do what? We can pay it out in the form of dividends. And if we do that, that will be one of the decisions that we have to make. If we don't pay it out as dividends, we can keep it. If we keep it, it's called retained income or retained earnings, and that will be set aside to finance the future growth of the business. So that's what dividend decisions is all about. Okay. And then finally, there's risk management. So risk is the probability of your actual outcome differing from your expected or your budgeted. Okay. There are several kinds of risks, and there are various measures that businesses can put in place to try to totally eliminate the risk or otherwise, at best, reduce the exposure to risk. Then there's a short section in the textbook that mentions ethics, which is extremely important in the financial world and the professional subjects such as accounting, finance, and tax. Okay. Another important concept is agency relationship and the agency problem. So first up, it must be very clear that these are two different things. So on the one hand, you have the agency relationship, and then we have the agency problem. So you would need to know the difference between them and to be able to describe both. So now, who is the agency relationship between? So this is just an example of the principal-agent problem. So the principal is the owner of the business, which in this case is the shareholder. The shareholders contribute the capital, but are not involved in the running of the business. So therefore, they appoint an agent in the form of the financial manager to act on their behalf and to ensure that the business is run in such a way that it maximizes the wealth of the shareholders. Okay. Then, what is the agency problem? Right, this is a different thing now altogether. So you'll be needing to know when the agency problem arises. So you need to be able to list, I would say, a good 4 possible causes of the agency problem. So let's see what the agency problem is. So it occurs when the objectives of the financial manager and the business are not aligned. So it's a mismatch, in other words, a conflict of interest. And it can take place when the financial manager seeks opportunities to maximize their own personal wealth and personal position at the expense of the company. So instead of making decisions based on maximizing shareholder wealth, which is what they should be doing, because that's the goal of financial management, perhaps they put themselves first and they make decisions that will increase their earnings. It will add to their power and prestige and reputation, etc. So there are lots of those that are explained in the book. And because it is so undesirable, the owners of the business implement various measures to incentivize financial management to act in the way that they are supposed to be acting, and therefore minimize the agency problem. So basically, these are called performance-related reward schemes. And what do you need to know there? Examples of them and how they work, at least 2, and to be able to discuss the advantages and the disadvantages of them. So that is basically Learning Unit 1 in a nutshell. Here are some possible questions that you could look at in the book. All right. So question 1.2 and question 1.4, those are in the front of the book. Do have a look at question 1.4 in particular, because there's a nice example, yes, and a nice solution at the back of the book in the form of a table. Then you can also look at question 1E and G, which come out of the question bank at the back of the book. Okay. Only my students in Pietermaritzburg will know what my Ask Task 1 is. But I'm sure that your lecturer has given you some questions of their own that you can use to make sure that you are fully understanding Learning Unit 1. So from my side, I'm going to end the recording so we can focus on some calculations coming from Learning Unit 2.